All right, guys, so let's get started. This is class one of the day trade course. So I know you guys are, I'm sure, all excited to be getting started here. We've been, for those of you in the live class right now, we've been talking about this for at least a couple weeks, getting ready for the live session. And so this is going to be a lot of fun. Now, the way these classes are going to run, whether you're watching on the live streaming version here today or you're watching this recording tomorrow or a week or a month in the future, we're going to have the class, and then at the end of the class, we're going to have a basically like an FAQ session. So the way we'll do this in the learning software is that you'll watch class one, and then you'll see the FAQs for class one. And some classes will have multiple parts. So this class is a two-part class. We've got part one, which is all of my slides, and then part two is going to be showing you how to use the fantasy stock trading simulator. All right. So, and then we'll do, I guess, part three, the FAQ section. But it's not really part three. It's just the FAQ section. All right, guys. So now I know a lot of you guys are beginner traders. Some of you guys are brand new to trading, meaning you've never even taken a single trade. Others have been trading for a few months. Maybe some of you have even been trading for a few years. But if you're in this class, it probably means you haven't reached the level of consistency that you've been wanting, right? So what I want to do is have you essentially learn everything that I know about the market, and it means you need to put aside what you currently know about trading. Everything that you think you know, you sort of have to put aside and focus on understanding my strategy. It may be different from how you've traded in the past or things that you've learned in the past, but it's a strategy that works really well for me. It's a strategy that I use to take $583 and turn it into 100 grand in 44 days. It's a strategy I used in 2016 to make over $222,000. It's a strategy that John is using, and he's in the room today, and he made $50,000 in February. He made $160,000 last year. All right, so this is a strategy that is tried and true. It works. It doesn't mean it's, there aren't things that you'll want to change for your own trading. You have to make, adjustments for your own risk tolerance, 100%. But I want you to learn this strategy. Now, the first thing that I'm going to say, and I'm going to say this a couple more times during the class, is that if you're trading with real money right now, I want you to stop. I want you to stop trading with real money while you're taking this class. The reason is because, number one, I don't want you live trading a strategy that you only halfway know. So just because you've watched maybe class 1, 2, and 3 doesn't mean you should start trading with real money. If you do that, you're like a med school student in their second trimester taking on an open heart surgery, right? You're not quite ready for doing that, and you're probably going to make a mistake, and it's going to go badly. And the thing is, the reality is with trading, I mean, it's not life or death, but the potential to lose all your money is there. Absolutely. That's the risk with trading. I didn't get serious about being a disciplined trader until I lost almost all of my money. And then it was the building back. It's because I had fallen all the way down to basically zero. And I was like, okay, well, at this point, I either have to get disciplined so I can figure it out, or I am, I'm going to have to look for a different job. So I don't want you guys to have to get, up with your back against the rope before you decide to get disciplined. All right. I want you to give me, the duration of this class to teach you my strategy. I want you to give me this period of time to not trade with real money, but to trade in the simulator. I'm going to give you access to our simulator. You guys all have access to the simulator. I've set up accounts for you. You've got $100,000 in virtual currency. You can practice trading there. Practice in a safe environment. All right. Now, over the next few weeks and few months, I'm going to be teaching you everything that I know about the markets. And I have found that I have a way of teaching students that resonates really well. And it's because I went through the process of struggling for years and years before I found any success. All right. So one of the things that you guys will quickly realize is that day trading is not easy, right? It's not. It's hard. And most traders who come into the market will fail. 90% will fail. They'll leave the market without finding any success. Success is a byproduct of practice. You have to practice. You keep practicing, you keep studying, you keep developing, and by doing this, you position yourself to be a success. But truth be told, not everyone has what it takes mentally. This is a career that will really challenge you. But for those who are successful, the rewards are well worth it. And for me to be able to make $60,000, $65,000 in some of my best months, I mean, obviously it's a ridiculous amount of money. I haven't lost sight of that. Okay, so one of the things that we say at Warrior Trading is learn to trade and live your dream. For me, learning to trade has allowed me to live my life 100% on my own terms. Day trading, in the morning and then teaching students in the afternoon, but just trading in the morning has given me the income to put me in the top 5% income bracket. All right, and it's incredible. I never would have guessed that I would achieve this level of success in my life. I knew I wanted to be a successful person. I just didn't know how to get there. I didn't know what path I would take to find success. And trading has been it. All right. So, I'm not tied down to an office. I can travel. I could travel as much as I want. And these are the realities of being self-employed as a day trader. It's financial independence. All right, so many of you guys, you're in different phases of life. We've got a lot of students who I'm sure are retired. We've got some students who are in college, some students who are kind of in the middle of their lives, switching careers, and you're all coming into this journey to become a day trader with the same goal, that you want to be able to generate some extra profit on the side trading the markets. All right, so regardless of your situation, if you become a successful trader, it will absolutely change your life in more ways than you could probably imagine right now. Now, here's the thing that's really important to understand. There are two phases for becoming a trader. Phase one, and this is the hardest phase, is strategy development. Phase two is trading a well-developed strategy. Now, once you have developed your strategy, trading is easy. I made almost $5,000 today, and it was easy. It was very easy. I just traded my setup, the same setup and the same strategy I've been trading for years. I sit down, I look at setups, I take trades, I'm up $5,000. It's easy. The hard part is not phase two. The hard part is phase one. The hard part is strategy development. And that's where all of you guys are at right now. You're in strategy development. Strategy development took me almost 2 years. So for 2 years, I wasn't making any money. I was struggling. Most traders don't make it through phase one. They don't get to the point where they have a strategy. They're just trading, they're practicing, they're trying to develop a strategy. They start trading various strategies with real money. They start losing money, and most of them blow up their account trading an unproven strategy. So when you think of trading in these two phases, you've got phase one, strategy development, phase two, live trading. You guys are almost all of you are in strategy development right now. So you shouldn't be trading with real money. The reality is, if you can prove in our simulator that you can be consistently profitable with 100 shares, then you have what it takes to be a successful trader. Your metrics will sustain, because trading is, as you'll soon learn, is all about metrics. You either have metrics that are that of a profitable trader or that of a losing trader. So if you're successful with 100 shares, you can be successful with 1,000 or with 10,000. If you can't be profitable in the simulator, you shouldn't be trading with real money. If you're currently losing money in a real account, you shouldn't be trading it. I mean, it's one thing to have one red week. I had a red week 2 weeks ago or a week and a half ago. But to have back-to-back red weeks or back-to-back red months is not acceptable. You're losing money. You're giving away money in strategy development. That's when you should be trading in the simulator. Until you've proven you can be consistent, and then that's when you transition to trading with real money. All right, so again, another reminder, don't trade with real money right now. You've got your whole career ahead of you. Now, I don't care if you're coming into this class right now saying, Ross, I traded, for the last 3 years on my own and I lost, $100,000. Or you're coming in and saying, Ross, I traded for the last 3 months. I was doing it on my own. I lost $30,000. I want to make that money back. I know you do, and I understand that because I lost a lot of money when I was getting started also. But you're not going to make it back all in one day. If you can learn the strategy that can generate $500 a day, you're making 100 grand a year. And you can do that for the next 10 years. You could potentially make $1 million over the next 10 years as a trader. All right. But it comes back to developing that strategy. So once you have that strategy to make 400, 500 a day, the losses of the past really don't matter. You'll make them back. I made all my losses back. I mean, at this point, I had one day where I made $22,000. So once you've got the strategy, you can scale it. And John, he's here today, and he can absolutely attest to that. We all have losses as beginner traders, and you can't get caught up and all bent out of shape trying to make back that money. Focus right now on strategy development. All right. So with that said, let's dive in now. During this class, obviously, we're going to go into all the details of day trading. And this is class 1, of course. And so, excuse me, I want it to be, I assume that most of you are coming into this class with a basic understanding of what trading is. We do have an entire section of our website dedicated to terminology. So if some of the terms I'm using right now are unfamiliar, you can, of course, Google them or go on our website and check the terminology section. Those of you watching the live stream here are going to see, those of you watching the recording will see a link to our terminology section below in the class. All right, but let's just start with broad brushstrokes. How does day trading work? All right, day trading is the simple act of buying and selling stocks intraday. So when we buy and sell stocks intraday, we have a very simple goal. We buy them and sell them for a higher price and make a profit. So we only make money when stocks are moving, right? We don't buy a stock at $5 to sell it at $5. We buy it at $5 to sell it at $5.50, to sell it at $5.75 or $6. We need stocks that are moving. The good news is that every single day there's a stock making a big move. In my first 18 months of trading, that's what it took me 18 months to realize. Every single day there's a stock making a big move. And I'm not talking about Facebook moving up or down 5 points. I'm talking about a stock doing something crazy. Now let's just step out of this slide for 1 second, and I'll give you that example. Today I'm up $5,000. APOP was our big move. This stock went from $8 to $13.50 in about 10 minutes. That right there is an opportunity. If you can learn how to capitalize on these opportunities through the strategies I'm going to teach you in this class, you can do really well as a trader. You will see these opportunities all the time. And you know what? You only have to have a day like I had today, twice a month, to make $100,000 a year. You don't need to overtrade. You need to be very selective about what you're willing to trade. That's one of the things that we're going to talk about a lot. But the reality is most traders take way too many trades. I trade an average of 3 times a day, and I'm making 6 figures. Don't overtrade. Focus on the best quality setups. Now, I'm not going to use a lot of military analogies during this class, but the one I'll use is the sniper reference. And that as a strategy, we are so honed in on an A quality setup, all we need to do is be patient, to sit and wait for it. And when we see it, we strike. Now, for me, I have the experience and I've got the confidence to strike with large share size. So I can be aggressive. I could take 10,000, maybe even 15,000 shares of some of these trades. That level of confidence comes with experience, and you'll get there in time. But right now, I want you to understand that one of the hardest things about trading is learning to be patient, learning to sit there while you wait for that A quality setup to form. All right, so this was an A quality setup today. Now, you could have traded Facebook today. Some people try to day trade Facebook today, I'm sure. And you know what? You're not going to see very clean price action. The volume on Facebook today is pretty average. Really nothing special. That's Facebook. Let's look at another big one. Netflix volume today, pretty average. You've got some opportunities, but this is a very expensive stock. Even from 140 to 144, you're talking about percentage-wise, just not very big moves. And this is probably one of the biggest days it's had in a long time. All right. Now with APOP and GBR, the other stock I traded today, these are stocks that were both gapping up, surging up, moving with volume, and both offered some really good opportunities. If I pull this back, I'll show you the places to enter this stock are on this pullback here on the second one right here, and on the third one right here. These are simple opportunities, and we'll see them again and again and again. These are the places to get in and get out. These are the times where you take 1, 2, 3 trades, you get into the market, you take the profit, and you get out. You don't overtrade. Now, the thing that APOP and GBR both have in common is that they're both stocks that are under $10. They're both stocks that are gapping up, meaning they're opening higher today than they closed yesterday, and they're having a catalyst. Whether that catalyst is actually a headline like news or a technical breakout, there is a reason that these stocks are moving higher. These are the type of stocks retail traders go for, because you know what? This stock went from $2 to $3.50. That's a big opportunity. APOP going from $8 to $13, that's a big opportunity. You can make a much bigger profit on those stocks than you really could on Facebook or Netflix, especially if you have a small account, because most traders have small accounts. Most retail traders have small accounts, meaning, they need bigger percentage gains. If they want to put all of their account into a stock like Netflix, they're not going to make as much as if they put all their money into a stock that's going to move 20, 30, 40, 50% in a single day. Let's look at HTGM. These are the types of stocks we trade. HTGM from $2 all the way up to $13.25 in 2 days. That's an opportunity. And you'll see stocks doing this again and again and again. We'll have lots of examples during this class. Your job is to learn to capitalize on these opportunities, to get into the market, to book your couple $100 of profit on low risk setups and get out. Any day that you take money from the market, you're doing something that 90% of traders can't do. All right? So you have to be super focused on getting in, getting your profit, and then getting out. All right? Making a living trading, yes, it's hard to learn, but once you've got it, it's easy. The day-to-day work of trading is easy. And this is kind of in contrast to other things that I've done in life. When I was younger, for instance, I did a lot of landscaping. Landscaping is very easy to learn and extremely hard to do on a day-to-day basis. I mean, it's backbreaking. It's manual labor, and you don't get paid really that well. It's very hard to do. Day trading is reversed. It's very hard to learn, and then once you have it, it's very easy to do. Okay, so that's kind of the thing. I think that's true with probably a lot of very skilled jobs. Getting the skill is very hard, and then once you have that skill, you've got a career for a lifetime. Okay, so now also a reminder, many of you guys are Warrior Pro students, but some of you are Warrior Starter students. So you'll be in this class only for the first 4 classes, and then you'll have the choice whether you want to continue on or not. Now, most of you continue on, and this is just looking at what most Warrior Starter students have done. So you go through classes 1 through 4 and continue with 5 and on because you want to keep learning. All right, I want to see you guys succeed, and again, that means you need to complete the course, you need to be focused, you need to trade in the simulator, you need to practice. All right, so as I said, the big discovery for me in my first 18 months was realizing that every single day there's a stock that moves 20 to 30%. And this is what I thought to myself. At that time, I had a $25,000 account, and I was basically down to, I couldn't put more money in. So I needed to either make it work or I was going to have a problem. And I realized, okay, I've got $100,000 in buying power. If I put half of my account into a stock that goes up, 10%, right? My account is growing very quickly. So if I make 10% on $50,000, which is half of my account, that's a $5,000 gain. That's my account growing by 20%. So if I put half of my account with the buying power into a stock that goes up 20%, I'll make 40%. And that's what I realized. Every single day I see these stocks, these are opportunities to grow my account. And I'm not going to grow my account like that if I trade Facebook, if I trade Apple, if I trade Tesla. My account is not going to grow 10% a day when I'm having good days. Today, my account was at $100,000 and I made $5,000. That's 5% account growth in one day. Most mutual funds, if you get 5 to 8% in an entire year, you've done well. And a lot of people put 100 grand into a mutual fund. If you have millions and millions of dollars, obviously you find other ways to generate profit other than day trading. But with a small account day trading, the focus has to be on these lower price stocks because they're the ones that make big moves. So if you can capture even half of these 20 to 30% moves each day, you're going to do really, really well. Now, that's the strategy that I use. That's the approach that I used to take $583 and turn it into 100 grand in 44 days. All right, so the topics over the next 15 chapters, you can see here. Today, we're going to be talking about becoming a day trader, and I'm going to go over the topics covered today specifically and how to use the trading simulator. Tomorrow, or in the next class, we'll be talking about risk management. We'll go into stock selection, candlestick patterns, popular chart patterns, momentum trading, reversal trading, parabolic stocks, stock scanning, level 2, tape reading, hotkeys, trade management, psychological factors, and in this class we'll talk a lot about the emotions involved with trading. Chapter 12, trading plan for the next 3+ months and running your business as a day trader. Chapter 13, overview of trading tools. Chapter 14, 5-cent tick pilot program. Chapter 15, day in the life of a trader, live recordings of me trading. All right, so that's that's the itinerary. Now, those of you who are watching this first class, you may have questions about my reversal trading strategy. You may have questions about candlesticks. Wait till you watch that class before you ask those questions, because there's a really good chance I'll answer all of those questions in those classes. All right, so today we're going to learn about, obviously, what it is to become a day trader. We're going to talk about opening your first account, margin accounts versus cash accounts, PDT rules, leverage, order types, routing options, the bid, the ask, level 1, level 2 basics, long versus short, the short sale restriction, and then, of course, we're going to get into teaching you how to use the trading sim. Why is this important? Well, these are the concepts that really will become your foundation as a trader. We've got to build your foundation. All right, so we're going to start with the basic building blocks, and once we've got these really, set up, then you can start really building your knowledge off of them. Okay, so obviously, what is day trading? We've already kind of talked about this. A simple act of buying and selling shares in the period of one day. So day trading became popular in the 1990s and is continued to be a popular but extremely challenging career. And more than 90% of traders will fail to become profitable. So I believe those failures are a result of trading with a lack of strategy, without a plan. All right. Now, as of September 30th, 2015, Ameritrade had 6.6 million accounts funded, and their customers averaged 1.5 trades a month. So active traders who execute more than 3 trades a week, we are a bit of a rare breed. All right. Now, during this course, we will discuss the leading cause of failure, because it is important for you to understand why most traders struggle. And I'm going to show you what I believe are the best strategies to avoid failure. And of course, the other side of that is the best strategy to ensure success. Now, the process of becoming a trader, and this is kind of an 8-step process. What I've done is I've made a lot of kind of 8-step, 5-step type of guides, because I think these are really helpful for beginner traders, especially when you're taking notes and stuff like that. So the process of becoming a trader: learn the terminology. All right, learn the core concepts, learn a trading strategy, learn advanced concepts and how to use the best tools, write a trading plan, and begin trading your strategy in a simulator. Right? Then we review your simulated trading metrics and decide whether or not you're ready to trade with real money. If you're not ready, you keep practicing, keep refining your strategy until you're at a point where you can generate positive metrics. So what are the tools that you need? The basic tools for a day trader: number 1, a trading laptop or a desktop. Number 2, high-speed internet connection. 20 or 30 megabits per second or faster is ideal, but I traded on DSL for a long time. So if you have just dial-up or even HughesNet, you can probably get away with it for a while, but you'll at some point probably want to upgrade to cable if you can. Number 3, most important, a profitable trading strategy. And number 4, a broker account. But you know what? You don't even need a broker account until you have that profitable strategy. Until you've got your strategy down, the broker account isn't going to help you, right? Now, a little bit later in this class, I'm going to talk about the type of computer that you want to use as you're getting started, and I'm going to give you kind of the breakdown of the computer that I'm using. All right, so once you are ready to open your first account, you've got a lot of choices. Now, many of you may already be trading live, and of course, I want you guys to shut down those live trading platforms for the time being and trade in the simulator. But in order to trade, you will need to fund a broker account, and there's a lot of choices out there. The reality is, there's not one broker that's right for everyone. I mean, the reality is everyone has different needs. Swing traders have different needs from day traders. Options traders have different needs from active day traders. So, given that, there are a certain set of criteria that you need to look for in a broker that you're going to use for day trading. All right. Number one, fast executions. Some brokers will guarantee that your orders will fill in 1 second or less, or you get free commissions. I mean, that's fine, but ultimately we want our orders to fill instantly. As soon as you press the buy button, you want the orders to fill. Now, I've realized that there are firms that really cater to day traders and have really quick executions, and then there are firms that just don't. I mean, they're just not as fast. So you need to have a firm that's going to give you really quick executions. Number two, this is a must. You need a reliable and stable platform. Now, I trade with desktop platforms because they're more stable than web-based platforms. A lot of the web-based platforms will crash. Mobile is even worse, right? You don't want to day trade on a mobile app. You just don't. You want a desktop app. You want a desktop computer or laptop, but you need a desktop application that you download and then you can run when you launch it from the taskbar. This right here is the Dash Trader platform. This is utilized by several brokers, including Interactive Brokers, Speed Trader, and Sure Trader. This is the Lightspeed platform used by Lightspeed Financial. And you can see these are they're relatively similar. I mean, I'll go back here. The Speed Trader platform or the Dash Trader platform, you've got your level 2 here, your buy and sell buttons, kind of account info. Here you go with Lightspeed, you've got the buy, the sell, account info over on the side, level 2. Here's Ameritrade. You've got, this is a little different. Ameritrade is not always as intuitive, but this is a pretty advanced platform as well. All right. Number 3, direct access routing. And this is something that you won't find with E-Trade or with Ameritrade. Direct access routing is the ability to choose how your order is sent to the market. Now, you can see here with Speed Trader, these are all of the different paths that I can take to get to the market. All right, so picture the market as an island. All right, so the market is an island, and there are, let's just say, 10 different docks all around the island. So these docks are named BATS and EDGX and ARCA and NYSE and INET. Okay, you can choose which route to take to get into the island. Now, most brokers, all brokers actually, have their just default limit order right here. A limit order is a smart route, and what it'll do is it'll send your order out to the market, and you don't really know which path it's going to take. It'll get to the island, but you don't really know how. Now, the problem with this is that for me, when I do quote smart routing, it seems that the orders are always a little bit slower than when I direct route. It's for any number of reasons, but one reason is that the broker is going to most likely route your order towards the dock or the ECN, Electronic Communication Network, that either gives them the highest rebate, which is good for their business, or that for whatever reason they just use the most frequently. And that may not be the best one for you. That may not be the route that gives you a really quick fill. All right. Now, to do direct access routing, you have to pay a fee. Think of that fee as the toll. This is like a toll booth, right? You're going over a bridge and you've got the toll. So the fees are typically 0.0015. So that's a 15th of a penny. So it's $1.50 for every 1,000 shares. It's not a very big toll, but it's a toll that you'll have to pay. Most brokers that are full service brokers like E-Trade and Ameritrade, they only have limit or stop and market. They don't give you the option to do direct access routing, and if they do, it might only be with one or two routes like NASDAQ and ARCA. So the flexibility to have all of these routes is an advantage for a trader. Now, the reality is, for me, I just choose one and use it all the time. I really like ARCA, I like EdgeX, I like INET. And these, they're all pretty much equal, but compared to a smart route limit order, they're faster. All right. Now, later in the class, not today, but later in the course, we'll talk more about routing when we talk about hotkeys in level 2 and stuff like that. But just for right now, know that when you're looking at a broker, you want to make sure you have direct access routing. Okay, so that would include Interactive Brokers, Lightspeed, and SpeedTrader. Okay. Number 4, hotkey functionality. A hotkey is when you press Shift 1 and you could buy 1,000 shares like that. That's very important because it allows you to trade quickly. I'll show you lots of examples of me trading with hotkeys where I get in and I get out sometimes within 10 or 15 seconds. I'm capitalizing on short-term opportunities in the market. Now, being able to get in quickly is important. Being able to get out quickly is even more important. When you're up $1,000, you want to lock in that profit, and that means you need to be able to have a hotkey to quickly get out of a trade. For me, I use Control Z, and it'll automatically calculate my position size to sell it. So I can get into a trade literally as quickly as pressing Shift 1 and Control Z. Think about how fast that is. That's really fast. And number 5, low commissions. Right now, last year I paid over $30,000 in commissions. Okay, so commissions are a factor, but the reality is, at SpeedTrader, my commissions were about 70% less than if I traded at E-Trade or Ameritrade. If I was trading at either of those firms, I probably would have spent $90,000 last year in commissions, and that would have been insane. Okay, so if you're trading, 2, 3, 4 times a day or more, you need to shop around for the lowest commissions. Most of these direct access brokers will give you 2 commission structures. One is where you're charged per trade. It's a ticket for each trade. All right, so a typical commission per trade would be like $5 a trade. All right, so whether you take 100 shares or 10,000 shares, it's $5 a trade. The other commission type is per share. So some brokers will do something like half a penny per share, which means if you only trade 100 shares, it's only 50 cents, which is great. But then if you trade 10,000 shares, it's $50. So per share is only beneficial when you're trading less than 1,000 shares. Once you're trading more than 1,000 shares, per share is going to be too expensive, and you want to usually switch to per trade. Now, you can usually sign up at a per share commission structure and then switch to per trade a few months down the road. You can't flip flop like a lot, but you can take a switch and let them know. That's usually not a problem. All right, so those are the 5 things that you want to look for in a broker. And on our website, we have a list of the top brokers that we refer our students to and the brokers that participate in our rebate program, so you'll get your education paid for by the broker. All right, now, when you go to open your trading account, there are 2 types of accounts that you can open. Number 1 is a cash account, and the second is a margin account. Now, a cash account is when you write a check for $25,000, you put that $25,000 into your broker account, and you show a $25,000 balance. You can buy $25,000 worth of stock. But when you buy that, and then when you go to sell it, you have to wait 3 days for the trade to settle before you can reinvest those funds. So how would that possibly work as a day trader? Right? If you take 3 trades and those each have to wait 3 days, you'd have to have a huge amount of money just because you're waiting every single day for settlement. Well, that's where the margin account comes in. A margin account will allow the trades to settle instantly. Now, even though the trade still takes 3 days to settle with a broker, the broker is basically saying, look, I saw you sold the trade. I'm going to just go ahead and give you the credit for it now. Let's all assume it's going to settle because trades always settle in 3 days, so you can keep trading. And that means with $25,000, you can trade again, 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 again. You could trade 1,000 times in a day. You could trade $10 million worth of stock because every time you sell it, it resets your buying power back to 25,000. That's the advantage of a margin account. But here's the catch. In order to day trade with a margin account in the United States, you need to maintain a $25,000 minimum balance. If you have less than $25,000, you can only day trade 3 times a week. So that is the challenge. Day traders generally use margin accounts, and that means we don't have to wait 3 days for settlement. Plus, we're given something special, which is called leverage. All right. Now we'll talk a little bit more about leverage, but in a second. But just to give you the understanding right now, when you put in $25,000, and it's almost crazy to explain this to someone who's never heard of it because I don't even know why they do it. It just seems crazy to me. But you put in $25,000 and they're like, we'll take that $25,000 and we'll give you 4 times leverage. So now with a $25,000 cash account, you have $100,000 in buying power. I mean, it seems crazy to say it, and that's just the way it is. So margin accounts give you 4 times leverage. That means with $25,000, you can day trade with 100 grand, which is one of the reasons a lot of traders get in trouble. They put in $25,000, $30,000, and all of a sudden they've got all this buying power. They've got more money than they have knowledge, and they make big mistakes. All right. So now the pattern day trader rule. This is the rule that states that you need the $25,000 minimum balance. Okay. Now this rule was designed after the kind of dot-com bubble of the late 90s when day trading became really popular because so many traders lost their shirts when the bubble burst. All right, so they wanted to prevent inexperienced traders from making big mistakes and getting in over their head. And the PDT rule states that if you execute more than 3 day trades in a 5-day rolling period, that you're a day trader and you must maintain a $25,000 minimum balance. All right, so this obviously is a challenge for a lot of traders. For me, when I got started, I maintained my $25,000 balance. There are a couple different workarounds that a lot of traders will use in order to trade, even if they only have $500. For instance, when I did my $583 challenge, I funded my account in the Bahamas because brokers in the Bahamas don't have to enforce the SEC rule for pattern day trader. So you put in $500 and you can day trade as much as you want. So I did that for, whatever it was, 5 weeks or so until I broke 25,000, and then I took all my money out and I put it in a US firm. That's where I want my money to be. That's where I feel like it's safer. But I knew that as a beginner trader, with $583 balance, I had more money, but obviously 583 was my starting balance at that time, that I needed to trade in the Bahamas. So that's something that a lot of traders will do. Other traders will look into prop firms or maybe hedge funds, but there are a few options, and these options are really designed to be used until you hit 25,000, and then you can open an account with a firm in the United States. Now, Suni just asked the question of, could he have multiple accounts? Could you have 3 accounts so you can get around the PDT rule? You can, and I tried that. The problem is that you're dividing up your money. So if you have 3 accounts, you have $5,000 in 3 accounts, yes, you could trade 3 times in each of those accounts. That's true, but you can't really take very many trades with $3,000 or $5,000. And so for me, it just made more sense to have all my money in one account when I was getting started. And then eventually I put in enough money so I was above the $25,000 level. All right, so the pattern day trader rule applies to every broker in the United States. E-Trade, Ameritrade, Interactive Brokers, Lightspeed, Speed Trader. All right, the only firms that don't enforce that are firms that are overseas. Some overseas firms will not accept U.S. residents. Others will. So you have to look around a little bit. There are a few options out there. And again, they're really kind of a Band-Aid to get you until you've got 25,000, and then you put your money into Speed Trader Lightspeed or whatever US firm you prefer. All right, now leverage is dangerous, and with margin comes leverage. So once you've been approved by your broker for a margin account, they will give you leverage. Now, remember, when you apply for margin, you have to sign an agreement. It's a margin agreement that you agree if you, let's say, because they gave you 4 times leverage, let's say you put in $25,000 and you lose 50 grand. The margin agreement states that you owe the broker the difference. You owe them $25,000, and that's why margin and leverage can be so dangerous. All right. With U.S. firms, leverage is always 4 times during the day and 2 times overnight. Those are SEC rules. So you won't see a broker that gives you more. You won't see one that gives you less. Actually, there might be some that give you less. They can restrict margin if they want to, but they can't give you more. So that means your $25,000 balance gives you 100 grand in buying power. Right now, I've got 100,000 in my Speed Trader account. That means I've got $400,000 in buying power. But remember, your broker is letting you borrow 75% of that. So, that privilege carries great responsibility. All right. I mean, you just have to be super, super smart. So obviously, you guys, some of you are saying, look, I don't have $25,000, so what am I going to do? Well, the Bahamas route is the path that I took. It was for me the probably best way and one of the few ways that I could trade with a $500 account. Now, because they're in the Bahamas, they're also not limited to 4 times leverage. One of the firms, SureTrader, gives you 6 times leverage. So you put in $1,000, you have a $6,000 buying power cap, which means you put in $2,000, you've got $12,000, and you can very quickly generate profit. And that's how it worked for me when I started with $583. I had $3,000 in buying power, and as soon as I built up that account, my buying power increased by 6 times. So every time I added $1, I got $5 more, $6 of buying power. Yes, Albert, the commissions were higher. The commissions at SureTrader are $10 for 1,000 shares. So they are higher. And that's kind of the price that you have to pay when you're below that threshold. The reality is you trade there until you hit your $25,000, and then you can open an account where the commissions are lower. I mean, that's really sort of the purpose, I think, that for most people. All right, so opening an account with a broker is very similar to opening a bank account. You need to provide 2 forms of ID, usually your passport and your license. You need to sign agreements. Sometimes you need to show proof of residency, utility bills, something like that. And you've got to sign your margin agreements, and you also have to disclose your level of experience as a trader. Now, when I first started trading, even though I had 0 experience, because I knew a little bit about the market, I said I had some experience. If I had told them I had 0 experience, they probably would have denied my margin account. So, I said I had some experience. I did know about trading, and my account was approved. Once it was approved, it was ready to be funded. I always fund my accounts with wire transfers because sending a check takes too long. It just always takes forever. So I do wire transfers with SureTrader. On and off over the years, you've been able to fund your account with a credit card. U.S. brokers, I don't think let you do that, but SureTrader does. So that's an option there. And for those of you international, TradeZero is a great option, and their commissions are actually really low. They're lower than SureTrader, but TradeZero does not accept U.S. residents, at least as of today. Okay, so as I already said, I suspect that many of you have active trading accounts. And you've probably tried your hand at some live trading. And if you're here in this class, it's probably because you're not seeing the results that you want. So if you're in that group, and I'm not naming any names, I would encourage you to stop trading in your live account while you're taking the class and instead trade in the simulator, right? So don't worry about opening the account right now. Once you open the account, you'll probably have like maintenance fees and stuff like that. Just trade in the simulator for the next few weeks, next couple months, build up your metrics and prove that you have what it takes to be a profitable trader. Now, when you set up your account, and this is true not just with brokers, but also it's true with eSignal, it's true with Trade Ideas. You have to subscribe to data feeds. All right. So when you open a new account, they ask you, what data subscription do you want? And I always tell them I want NASDAQ TotalView. Some other subscriptions include like regional quotes or like ARCA book quotes, but those aren't as in depth as NASDAQ TotalView. I subscribe to NASDAQ TotalView and that's it. Now, they'll also ask you if you are a professional trader. Now, a professional trader is actually kind of funny. And if you are one, you already know. A professional trader is one that has their license. So that means you're licensed as a registered stockbroker or a financial advisor, and you have your series, 6 or 8 or 66 or whatever it is. So if you're not licensed, then you're a non-professional. Okay. So let's see. Now, let's see. Again, I've already said this several times. So you guys know, just really, really important. I've had students who email me after class, 3, and they're like, "Oh, I blew up my entire account. I can't keep trading." And I ask them, "Why are you trading with real money when you haven't even watched the class where we talk about strategy development? You're at the very beginning of your learning curve, and you're shooting yourself in the foot by doing that." So you definitely need to understand that right now you're in the strategy development phase. Until you've proven that you have a profitable strategy, you shouldn't trade with real money. All right. Now, taking your first trades when you're trading in the simulator, you might suddenly realize that there's a little bit more to know before you press the buy button. There are several options, there's several different ways you can take trades. So I want to walk you through the basic process of taking a trade so you guys can start practicing in the simulator. And you need to practice a lot every single day. Even though I only trade, 3 to 4 times a day, as a beginner trader, practice a lot, trade a lot, take trades because I want you to get a feel for it. I want you to get a sense of what it's like to watch these charts, what it's like to get into a position and get out of position. So the first thing you'll notice is that there are several order types. You've got market orders, limit orders, and stop orders. Those are the 3 basic types of orders. All right, so a market order is an order to buy or sell that will get you shares at market price. Basically, you're saying to your broker, go get me 1,000 shares, and I don't really care what the price is. Market price is whatever it is. That means typically you'll get every single share you asked for, but you'll get them at a high price. Day traders rarely use market orders. They're too risky because you can't manage risk when you don't know what price you're going to get filled at. Now, there's also the issue with a market order that what if you accidentally type in 100,000 shares instead of 10,000, right? And for someone like me, I might even have the buying power to buy 100,000 shares of a $2 stock. With a market order, you will get filled and you will get a lot of slippage. If I pressed a market order to buy 100,000 shares today of GBR, I probably would have gotten 50 cents of slippage. That's a $50,000 loss like that. That's the risk of using a market order. Now, if I put in the limit order to buy 100,000 shares, I would only fill up to my limit price. When you send a limit order, it sends the order to the market immediately, but you won't get filled higher than your max price. So if you put a max price at $3 and you press the buy button at $2.95, you'll get filled at $2.95, maybe 96, 97, 98, 99, and 3, but you won't get filled if it suddenly pops up to 350. You won't get filled anything higher. That's important. You've controlled your risk. I use limit orders. Now, a stop order is the type of order that triggers when the stock crosses a certain price. These are typically used to manage your risk. So if I'm in a stock at 295, I could set my stop at 280. And as soon as 280 crosses, my order will fire. What some traders do is they set buy stops. Now, a buy stop order is when you say that I want to buy a stock as soon as the price crosses $3. And as soon as the price crosses, your order will trigger and you'll get filled. It'll be a buy order. I personally don't use stop orders to buy positions. I actually don't use them very often for managing risk either. I just use limit orders and I use my hotkeys. By using hotkeys, as soon as a trade doesn't look good, I can get out. I can press Control Z and bail, and I'm out of the position. Now, within the order type of stop order, there are three types of stops. Okay, to make things more complicated, you've got a regular stop order, which when the price triggers, it'll send a market order. And then you have a stop limit order, which means you have the trigger price, and then you have the most you're willing to pay or the most you're willing to accept when you sell. All right, these are just like a regular limit order, except the trigger is a stop price. And then the third is a trailing stop. Now, a trailing stop is a moving stop order. It moves X number of cents behind the current high of day. So you could set a 20-cent trailing stop, and if the stock moves up and then pulls back 20 cents, your trigger will get fired and you'll stop out. So trailing stops can be good to help you stay in a position longer. The problem, and the reason I don't use them, is that they always fire when the price is dropping. If they fire when the price is dropping, you're most likely going to get slippage going down. Slippage is the difference between when you press the button to sell or buy and when you actually get filled. There's a slight change in price. On a really fast moving stock, that change could be 50 cents. On another stock, it might only be a penny, but some stocks will have more slippage and that creates more risk. All right. So in addition to those three stop types, you've got these other two. So I guess these are 5 stop types. You've got mental stops, and then you have live stops. Now, a mental stop is when I say in my head that if the stock goes below X price, I'm out. So if the stock drops below, let's say 350, I'll sell. But it only works if you have the discipline to press the sell button. A lot of traders don't have the discipline to do that. They say in their head they'll sell at 350, and then when suddenly it drops to 340, they say, well, I'll keep holding and we'll see what it does. Next thing you know, it's at 330 and 320, and they're like, well, I'll hold it until it breaks $3. The next thing you know, they're selling it at $3 and losing an extra 50 cents. Right? How many traders have experienced that? So that's the advantage of using a live stop order. You place the order with your broker and you delegate that responsibility to the broker, right? You let them handle the job of selling your position, when you're taking a loss. So I don't think it's a bad idea to use live stop orders as a beginner trader. Now, when we get into the simulator, I'm going to show you how to set a live stop as soon as you get into the trade. That's going to help you mitigate risk. And you can do that with a live trading account as well. I'm personally at a point, several years into my trading career, where I can finally, most of the time, count on myself to hold a mental stop. But that's still only most of the time. Sometimes I still hold past my mental stop. So live stops are a good idea, especially as a beginner trader, because it teaches you discipline. All right? I mean, it just forces you to get out of the trade when it goes the wrong way. Now, during this class, we're going to talk about some of the struggles that a lot of traders have with accepting loss. Okay, so we will get back to that, and mental stops, it's kind of what made me think of it, but we will come back to that in a few minutes. All right, so now order routing methods. Now, we already talked about this when we talked about direct access routing. So you think of the market as an island where the buyers and sellers meet to exchange shares. Dozens of bridges to the island, dozens of different routes. These are called electronic communication networks, ECNs. Like bridges, ECNs charge tolls for their use. All right, so those tolls are essentially a commission, an ECN fee. Some brokers, like E-Trade, Ameritrade, don't give you very many options of how you can route. And that means essentially you've got an entire island with buyers and sellers, but you can only see one part of it. And that's not really to your best advantage if you're an active trader. If you're a swing trader or a long-term investor, it probably doesn't matter. But as an active trader, you need to get max liquidity. You need lots of options of how you're going to send your orders to the market. All right, now every single stock has a bid price and an ask price. Okay, so when you're getting ready to place your first order, first you have to decide on what order type you're going to use: market, limit, stop, etc. And then you have to think, well, what price am I going to get in this thing at? You've got the bid price and you have the ask price. And you can place trades either at the bid price or the ask price or in between. In between is called the spread. All right, so the spread is the difference between the bid and the ask. Now, the bid is where buyers, people who want to buy the stock, can place orders. Now, if you get filled on the bid price, this stock is trading at 230 by 231. So if you get filled on the bid price, you got filled 1 penny better than the ask price. So you could put your order here to buy on the bid, but when you're a buyer on the bid, you have to wait for a seller to come sell you shares. All right? So you're sitting there waiting for someone to come to sell you shares. Alternatively, when you want to sell a stock, you can sell it on the ask price. You'll get the best price when you sell it up on the ask for 231. It's an extra penny, but you've got to wait for a buyer to come buy shares from you. So you can sell on the ask and you can buy on the bid, or if you want to get into the trade immediately, you can simply buy from one of those sellers up on the ask. All right? You can buy from a seller on the ask and you'll get filled right away. You'll get filled a penny higher than the bid price, but you'll get filled right away. Alternatively, if you want to sell, you could sell on the ask, or you could sell to one of those buyers sitting on the bid and you'll get filled immediately. All right? You can also place orders in between the spread. Sometimes they fill, sometimes they don't. It's kind of, you never know. All right? So level 1 is the first depth of the market. Level 1 shows you the current bid and the current ask. And usually you can see the number of shares sitting as a buyer or on the ask as a seller. Now, these are shown in sort of an abbreviation. 155, you add 2 zeros. This is actually 15,500. 3 is 300. So they drop the zeros to make it easier to read. Okay, so here you've got 15,500 shares sitting as a buyer at 230, and you've got a seller of 300 shares at 231. Okay, so if you wanted to buy this stock, there are 300 shares available right here at 231. Now, you could buy those 300 shares. If you wanted to buy 10,000, well, that becomes a little bit of an issue, right? Because there's only 300 shares for sale. And that's when you need to get a better understanding of the depth of the market. Now, if you wanted to sell, you could sell 15,500 shares right now to this guy here. He's sitting there holding up, he's got an order there, so you could go ahead and place that order if you want to. Level 2 is the second depth of the market. It shows you essentially how many buyers and sellers you have on the bid and the ask. And this little window here, it's actually kind of smaller. I should have blown this up, but this shows you all of the buyers sitting at this current price. So where level 1 shows you just the first one, this shows you all of them. Okay? So that gives you a better understanding that if there's 300 shares for sale on the ask at the current price, there might be 10,000 1 penny above that. So what you're seeing is, okay, this is the best bid and the best ask, the current bid and ask, and then you see the next level down. All right, so if a stock is 230 by 231, on the bid you'll see the buyers at 230, and then you'll see the buyers at 229 and 228 and 227 and 226. And on the ask, you'll see the sellers at 231, 232, 233, 234. Now each color represents a tier of pricing. Okay, so if I back out of this for a second, you'll see right here on the stock HTGM, 950 by, and this is across level 2. Sometimes this happens, and it happens after hours more often than during regular trading hours, so we'll switch to a different stock. So here we have Siri. We're going to pull the level 2 up on this one. Looks like we're trading right around 511, something like that. I don't know why this is loading slowly. But what you would see on the left is the bid and the buyers, and then on the ask, you've got the sellers. And at each tier, the colors will change. Let's pull up another stock. For some reason, I'm not able to load level 2. So obviously not the best example there of e-signal performance, but what can you do? All right, so here you go. 228, 12 by 2824. That's the first tier. So the next closest buyer is at 2811. That's only 1 penny down. The next closest buyer then is 2809. And then we go all the way down to 2775. On the ask, you've got a seller at 2824, another seller at 2829, another one at 2850. So you can see these sellers are a little bit more staggered out than on some of the stocks. Siri, if we can get this one to load, is almost definitely going to have a tighter spread. So you've got 510, 59, 511, 512, 513, 514. All right, so each color represents a different tier in price. I primarily just look at the current bid and the current ask, but you can look a couple levels down to see if there's a really big buyer or a really big seller. If it shows 0 on size, it means less than 100 shares. So it might be like 10 shares or something like that. All right, so let's jump back in here. So we're going to talk, we have an entire class dedicated to teaching you how to read level 2, because level 2 is something that's really important for you to understand, and we can go into a lot of detail on it. So know that you will learn more about that, but we're not going to get into it today. Right now, I just want you to understand what it is as a concept. So next to the level 2 window, you've got your time and sales window. So the time and sales is here where you've got the green and the white and the red. This shows you every single transaction that goes through. All right, so every time an order goes through, it'll print in the time and sales. And the old-fashioned tape machines, they used to spit out paper giving you the current quotes. It would show you the orders that were going through. You could see that's what reading the tape comes from. You could see these orders going through. You could see lots of buy orders or lots of sell orders. All right, so right here you can see on this stock you've got a couple green buy orders. Green orders mean they went through at the ask price. Red orders means they went through on the bid price. So a green is a buy, red is a sell, and white is a transaction that occurs in between the spread. All right, so that's one of the things that, again, we'll get into more detail when we get into reading level 2. So that'll be a little bit further along in the class. Now, in addition to understanding level 1 and understanding level 2, it's going to be really important for you guys to understand float. All right, so you have to realize that we're trading in a closed market. So what does that mean? Well, when a company has its initial public offering, they release a fixed number of shares onto the open market. That becomes the company's float. All right, so if the company, for instance, sells 100 million shares onto the open market, they now have a float of 100 million shares. And every time you and I are trading this stock, we're trading out of this fixed pool of shares. Now, there are a couple of ways that the float can change. All right, but generally speaking, on a day-to-day basis, that number of shares is the same. However, if a company decides to buy a large percentage of the available float, let's say a hedge fund decides to absorb 70% of the open float, well, suddenly that pool is now reduced, to only 30%. So now you've just got this small little pool. So every time we're trading shares out of this small little pool of liquidity. All right. Now, the reason why float is important is because float represents supply. The float is the supply. It's the amount of shares available to trade on any given day. All right. So what do we know about supply? We know that supply and demand have a relationship. So when you have really high demand and you've got low supply, price goes up. Okay? If you've got lots of supply and no demand, well, price usually goes down. We focus on trading stocks that have a limited supply, because during those 18 months when I was learning how to trade, one of the things I realized is that all of the stocks that move 20 to 30% have a few things in common. And one of the things they have in common is they all have a lower float. They have a float of under 50 million shares, and many of them have a float of under 10 million shares. All right, so with the small float, there's a very limited level of supply. Limited level of supply when you have very strong demand creates those 20 to 30% moves, and sometimes even bigger, like the move we saw today on APOP. Now, a stock like Bank of America has a float of over 10 billion shares, right? That's crazy. 10 billion shares. So in a practical sense, Bank of America moves very slowly. Even with great news, it's not going to move 30% in a day. Very, very unlikely. That means it's a safer vehicle for a long-term investment. It's less volatile. But day traders like volatility. We want stocks that are going to move and that are going to move in a predictable way. Now, something we're going to talk about in the next few classes on risk management and on stock selection is the importance of trading stocks that other traders are watching. The market moves because of collective trading mentality. Hundreds and hundreds of thousands of day traders out there all looking at the same handful of stocks each day. Those are the stocks that we want to trade. Those are the stocks that are going to be most predictable. They're predictable because when we see patterns forming, thousands and thousands of traders will see that as a buying opportunity. Okay, these are universal chart patterns that we're going to talk about, and these are seen by traders all around the world as buying opportunities. The more traders that see that pattern, the more obvious the pattern is, the better the breakout, because the more people will be buying it. All right, so you have to realize that on any given day, there are really only probably 5 or 6 stocks that are worth day trading. So I'm going to teach you how to find those in chapter 3 when we talk about stock selection. But for right now, I want you to understand that they're all going to have lower floats. We're not going to be trading stocks with 10 billion share floats because those aren't the type of stocks that you day trade. All right, now a stock that has a low float will also have a slightly different level 2. The level 2 is going to look different because you're usually going to have a bigger spread. This stock has a 3-cent spread right now. And this stock could very, very quickly, with only 100 shares for sale here, and only 1,100 here, and only 1,300 here, it could very quickly go from 18 to 20 to 21 to 27 and possibly higher. Likewise, if it drops, it could drop back down to 11 or 1082 very, very quickly. You can see that it's a little bit thinner. So when we talk about the stock being thin, this is what we mean. We mean that there aren't as many buyers or sellers wanting this stock. That means when you have a big buyer, or when you have a lot of buyers come in, the stock can move very quickly, right? And that's what will happen when you have demand, when you have a catalyst. In contrast, here's Bank of America. You've got over 100,000 shares on the bid. I could right now sell 100,000 shares of Bank of America, and it's not even going to move. I could sell $1 million of Bank of America, and it's no big deal. You can buy and sell that much, but you can't day trade it because it's not volatile. It's not likely to make 20, 30% moves. So this is a level 2 of very thickly traded stock. When we pull up the level 2 and we see 5 or 10 market makers or ECNs on either side, we know that this is a very thickly traded stock, and it's probably not going to make a very big move. So now that you understand the different order types and you understand level 1, you understand level 2, you're ready to enter a trade. This is what I do pretty much every single day. I'll type in here my share size. I'll click on the level 2, which will pull up the price. It'll populate the price right here, and then I can click the buy button. So I choose the ask, I double click it. That'll update the price here in this grayed out area. It'll automatically change from a market order to a limit order, and then I can press the buy button. And that's how quickly I can get into these trades. Now, alternatively, I can use hotkeys, but you can get in very quickly just pressing these buttons. If you are trying to trade on a web app or you're trying to trade on your mobile phone, you'd usually have to go through confirmation windows, and it would take you a lot longer to place orders. And you can see here the time and sales on the right, showing some red cells that went through just a moment ago. And this is kind of what my trading windows look like. I've got my level 2, and this is a very thickly traded stock right here, AKS. Lots of market makers on the bid, lots of them on the ask. Not going to move very quickly. You can see a little chart, you can see recent trades, and you can see positions, and then this would show my P&L, my realized, unrealized, shares, commissions, etc. All right, now for some of you who are beginner traders, you may be a little unfamiliar with what it is to be long and what it is to be short. Now, when you buy 1,000 shares of a stock, you're a long bias trader. You make money when the stock goes up. When you go long, you only lose the amount of money you put in the trade. So if you buy 1,000 shares of a stock at $10, you have $10,000 of cash in that trade. Worst case scenario, the stock goes to zero, and you lost you lost $10,000. Now, when you're shorting a stock, you sell the stock and it shows in your account that you're minus 1,000 shares. So you sold it. Now you have to eventually buy back that 1,000 shares to close out the trade, to make it go back to zero, to flatten it. So when you sell 1,000 shares, if you sell 1,000 shares at 10, you want to buy them back at a lower price so you make a profit on the difference. So you sell at 10, you buy it back at $9, you made $1 per share on 1,000 shares, that's $1,000. But what happens if the stock goes up to $20? Well, you're down 10,000 bucks. What happens if it goes to $30? You're down $20,000. What happens if it goes to 40, to 50, to 60, to 70, to 80, to 90, to $100 a share? You're down $90,000. What if it goes to $1,000 a share? You're down $990,000. That's the potential. When you're shorting stocks, you can lose an unlimited amount of money. So if a stock goes the wrong way and it goes up 10,000%, you could lose far more than you put into the trade. Now, as an example of that, let's look at DRYS. This is a stock on the daily chart. We'll back this up. That in one day did a move that, with a reverse split, this had a reverse split, but it went from $35 per share up to $816 per share. Now this is because of reverse split pricing. It actually went from $1 to about $120 a share over the course of 4 days. If you shorted 10,000 shares of this, you would have lost 100 grand. I mean, you would have lost you would have lost more than that. You would have lost 100 grand from $1 to $10. You would have lost $1 million as it went all the way up to $100 per share. I mean, you could get absolutely destroyed. And the reality is some traders did get destroyed on this stock. Now, traders got destroyed on this stock going long and going short because a trader who bought this up here at 700, well, 4 days later, it's back at $30 a share. This is the risk of trading. This right here is volatility. This right here is an opportunity. You can make profit on both the upside and the downside, but you have to understand the risk of trading. Trading is very risky. For me, I mitigate my risk by, number one, understanding that I never take a trade that I don't have the potential to double my profit versus the risk. If I risk 100, it's to make 200. Number two, I only take trades on A quality setups because even A quality setups are not right 100% of the time. I'll lose 25% of the time on A quality setups just because for whatever reason they don't work out. Okay, so you have to understand trading is all about being extremely focused. You have to be super, super focused, super meticulous about what you're willing to trade. So DRYS, that's one example. HTGM, this is one from just the last couple days. This went from $2 up to $13.25, and there were students trading in the simulator who we had a student on Monday trading in the simulator who lost over $30,000 shorting HTGM. All right, and I'm going to open my simulator here in a second so I can show you some of those trades. But I mean, that's just the risk. They were short on this day here on the 23rd, and on Monday, the stock gapped up and squeezed to $13 a share, which was ridiculous. I mean, it was absolutely ridiculous that it went that high. And yes, it'll probably come back down to $2. DRYS, it was ridiculous that it went all the way to 100, and it absolutely came back down. But can you hold being down $1 million before it goes the right direction? Most of us can't, and that's what can blow up your account. Okay, so we'll come back to that. We'll come back to the simulator in a few minutes, but for right now, I just want to make sure you guys understand the difference between being long and short, and most importantly, to realize that when you short stocks, you can lose potentially an unlimited amount of money. So there's a lot more risk there. Now, when we talk about short selling, there's a couple of other things that you need to understand. Traders who are short a stock are creating a negative share balance. That means they're selling the share, right? To sell those shares, they have to borrow them from their broker, which is kind of interesting. Your broker provides the inventory for you to short these stocks, for you to go negative on them. You can always buy a stock, but you cannot always short a stock. Your broker has to be able to give you shares to borrow. Okay, so that's what borrowing is called. Borrowing is when you borrow shares from your broker in order to short it. If your broker doesn't have shares available to borrow, you can't short the stock. IPOs are almost never shortable since most brokers don't have shares available yet. On the first day, they usually don't. Okay, so borrowing is when you get the shares from your broker. You don't have to do anything except when you go to take the trade, it'll show you in the window whether or not they have shares available. You don't have to call them or do anything. It's either shortable or it's not. You short it, and then when you want to close your position, you cover. It's called covering. So you cover, and that's buying the stock back to flatten your position. All right. Now, like a long-sided trader, you can scale in and scale out of short positions. You can add more. You can add, cover up some of it. It's totally your call. Now, there are a few different things that you have to also realize about short selling. Most stocks under $10 are extremely hard to borrow. Most brokers don't have shares available because when those stocks go from $2 to $10 or $2 to $100, most traders blow up their accounts. So they just make it easier by not even giving you the option. You can't even short those stocks. It's not an option. So even if you saw an A quality short, there's a great chance your broker won't have shares available if the stock is under $10. And some of the people that love shorting stocks, they end up having to fund 5 or 6 different broker accounts, hoping that among those 5 or 6 accounts, one of the brokers will have shares available to short. Well, 5 accounts at $25,000 minimum each, right? I mean, that's $125,000. Most beginner traders don't have that kind of money to fund several accounts. I know that I didn't. And even if I could right now, I wouldn't want to. It'd be such a pain. You'd have to get tax forms from 5 different brokers at the end of the year. It'd just be silly. You could probably already tell. I'm a long bias trader. And I'll admit that I have a bias. I prefer to trade to the long side, and I'll talk about why I prefer that. But I'm not saying short selling is bad. And I do still short. I will short stocks on rare occasions when I see a really, really good setup. But I just want you to understand the risk, and I want you to understand why I prefer to be a long bias trader. Now, when you're shorting, you have a certain number of days to cover your position. Your broker is saying, look, I'm going to let you borrow these shares, but not forever. You got to give them back to me in this number of days. So they could be 7 days to cover, they could be 14 days to cover, 30 days to cover, etc. But you have a period where you can hold the stock short before you have to cover up that position. So this is what can kind of fuel the short squeeze, because if you have a trader who's down on a short position and it keeps going up and up and up, eventually he's going to have to cover. And how does a short seller cover his position or her position? They cover by buying. They become a buyer. So when you have lots of people covering, you have lots of buyers. And when you have lots of buyers, you've got lots of demand and the price goes up. So the price can go up simply from shorts covering. And then that can fuel long bias traders coming in, seeing, look, this stock is squeezing up. I want to jump in and get a piece of it. You'll also know that, or note that stocks have short interest. Short interest refers to the number of shares that are currently being held as short positions in relation to the float. So if you have a 1 million share float and 200,000 shares are short, you have 20% short interest. So when you have 20% short interest and a stock spikes up 30%, 40%, 50%, you know that 20% of the people that are holding the stock are down big time. And that's when you can start seeing short squeezes. Traders covering their positions at market price, squeezing the price higher and higher. That's a short squeeze. All right. So when a stock suddenly spikes up, 20, 30, 40, 50%, and you have a high level of short interest, people that are short are going to start covering, and that fuels the imbalance between buyers and sellers. So imagine a stock that has, a 4 million share float. and they come out with news. Well, you know what? Let's just take a real example. Here we have APOP, a 3.3 million share float stock that came out with news overnight about their cancer treatment. Okay, and we know that biotech stocks can be crazy strong because when they have really good news, it can be something that is really big in the medical world. The stock goes from previous day of $6 up to a high of over 13. This went up over 100% in one day. Imagine if you were short 10,000 shares of this yesterday at $6. Today, you would have been down, $70,000 at one point. And what if at some point, when you're down $70,000 and your broker says, hey, wait a second, this guy only had $60,000 in buying power, we need to step in and take him out of this trade. The broker will go in, their risk management department will go in and they'll close his position at market price. You start having that happen across thousands of accounts on a stock that goes up 50% or 100% like this, you've got more buying. Plus you have all the buyers, like long bias traders like me, who are just like, look, the stock is going to be strong because it's got great news, and that's when you have these explosions. Again, you have to sort of have this understanding that the market is strong, not just because, Nike makes a good pair of sneakers or anything like that. It has to do with this collective trading mentality, right? It has to do with the way other traders have taken positions, what they're doing, what they're thinking, and how they're going to react when this type of situation happens, where you have really good news. Okay, so let's see. So that's APOP. Now, in addition to the short squeeze, you also have something that's called the short sale restriction. And this is when I start to feel that the market it has institutionalized there's a systematic long bias in the market. And over the course of the last 100 years, the market just has continued to go up. There is no such thing as a long side restriction. There's only short side restrictions, okay? Short sale restriction happens when a stock drops 10% or more in a single day. Once the short sale restriction has been turned on, traders cannot short a stock unless it's moving up. Isn't that strange? They can't short the stock when it's dropping. They can only short it on an uptick. So that means they can't short on the bid. They can only short on the ask. There is no such thing as a long buy restriction. A stock can be up 500% and you can still mark it in on the ask. So this is the market sort of creating these regulations to try to prop up stocks, to try to keep them from tanking. And nobody wants to have companies come onto the market and then go bankrupt. Nobody wants to have a flash crash where a stock or the whole market suddenly drops, 30% in a single day. And so this is one of those areas where when you have short sale restriction turned on for a particular stock, it's going to make it harder for the stock to drop, which is probably good for the company. Okay, and it's not good if you want to be a short seller. So something to understand there when you're starting to look at stocks to short is that if you have a short sale restriction, it's going to be harder for traders to short the stock. Now, when you're a long bias trader like me, what you love to have happen is you love to have a really strong stock drop 10% right out of the gates to turn on the short sale restriction and then squeeze through high of day. Because now, as it squeezes back through high of day, the people that would normally short the stock are going to have a harder time getting into it because short sale restriction is turned on. So it can actually fuel the stock to go even higher. Not only does it help stocks prevent them from dropping down, it can help them go up to the next level. So I am not against having short sale restriction on a stock that's moving up, and I don't trade stocks that are moving down in general. All right, now this is the DRYS chart. And just reminding you that there are incredible opportunities on both sides. Whether you're long bias or short bias, there are opportunities. Having said that, I'm a long bias trader. Historically, the market has been consistently strong. Despite some years of bearish markets, the market overall has been very, very strong. I'm not going to try to fight a bull market. We are, being a short bias trader and trying to short the world's strongest bull market can result in massive, massive losses. I would prefer to trade with the trend, to trade with the direction that seems to be, institutionalized even through regulations like the short sale restriction rule. So I trade to the long bias. Now, as day traders, we focus on the small picture. So, we're looking at stocks today that have breaking news, that today have a reason to surge up. Mutual funds that trade alongside the market, they might aim for 5, 8, 10% a year. We're aiming for 5, 8, 10% in a single day. Right? We're not going to find that by trading the type of stocks that mutual funds are going to invest in. So the focus for a mutual fund and for an institutional trader is different from the focus of a day trader. Day traders, we have our special place in the market. And the good news is that we don't usually have to fight against the institutional traders or the hedge funds or the big banks or the high frequency trading algorithms, because those are usually focused on trading the higher price stocks. They don't usually focus on the stocks under $10. That's the area where retail traders are usually focused. All right. So we're looking for stocks that retail traders like us would be interested in trading. Those are the stocks that, when they form the traditional bull flag, are most likely to resolve in the right direction. All right. Now, the SPY, the S&P 500, is something that we do look at as a gauge for overall strength in the market. And one of the things that you'll notice, especially, and this is true every single day, is that in the morning we have peak volume. And I could look at the SPY right now. Right at the open, we almost always have peak volume each day. High volume in the first hour, decreasing as we come into lunch, increasing a little bit in the afternoon, and sometimes in the last 5 minutes, but mostly just dead in the afternoon. Now, I don't put a lot of emphasis on the SPY. The S&P 500, that's a collection of it's a composite of huge stocks, huge companies. None of those companies are under $1 or under $10 a trade per share. Those are not the type of stocks that I would day trade. And I've actually found that I usually do better when the market is down slightly than when it's up more than, I think, 1.5%. Now, it's also important to recognize that Apple, as a stock, represents 3.5% of the S&P 500. And for every dollar that Apple moves up, the S&P moves 6.5 cents. So basically what you're seeing is one stock in the entire S&P 500 heavily influencing the entire market. If you overlay the Apple chart over the SPY chart, you'll see that they trade very similarly. So if you're looking at, let's just say for example, you're looking at Apple and you're like, oh, I think I want to take a trade on Apple, but you're not aware of what's happening in the overall market today, you're not going to realize that, well, there might be some economic news that's going to affect the overall market, and that could potentially draw down Apple. Because these stocks all trade together. If Apple starts to draw down, the S&P is going to come down. If for instance, you're trading a stock like Facebook and it has earnings and it moves up quickly, that's going to affect other stocks in the same sector. It becomes much more difficult to trade these stocks because their price action is going to be based at least somewhat on the price action of other stocks. So this is the Apple today and the S&P SPY right here. So similar. And neither of them are particularly easy to trade. Neither of them are showing you clean bull flags, clean patterns. These are choppy. These are traded by hedge funds, institutional traders, the high frequency traders, the algorithms. This is not something that you day trade. But it's not a bad idea to be mindful of the context of the overall market, because if the market is up 500 points, that could influence trading today. If the market is down 500 points, that could influence trading today. But on most days when the market is in range or up or down a little bit, it's not going to make a big difference for us. And I can scroll back here, several years of price action during the time that I've been trading, and you can see, well, the market's been, we had a dip from 2007 to 2010, and then since then we've been rallying back up. But even then we've had periods of real choppiness, periods of big sell-offs. We've had 1,000-point market crashes. You can see right in here where we had this day where the market suddenly dropped. I mean, it was a really pretty intense drop. We went from 210 on the SPY, and 2 days later we were down at 182. That was a 20% drop, in or a 10% drop in 2 days. I mean, that was really significant, and it was very choppy for a few weeks, and then we started to bounce back up. Despite all of that, during that time frame, there were still opportunities to day trade because there were still stocks that had catalysts. That despite what the overall market was doing, this stock, like APOP, came out with news of some cancer treatment. There are always opportunities like this each day. So I try not to get too caught up in what is going on with the overall market. Now, in addition to the SPY, some traders like to watch the VIX. The VIX is the volatility index, and this basically tells us it's a measure of fear in the market. So you can see, right around kind of the, we've had periods. I've got to move this out of the way. We've had periods where there was quite a lot of fear in the market, and then we've had periods where the fear really drops back down. So this is. Let me just go back here to the VIX. In general, though, it's clearly declining. As the market goes up, the VIX typically goes down. They have an inverse relationship. I do not trade the SPY. I do not trade the VIX. I do not trade commodities. I don't trade gold. A lot of traders, they get into trading. They think, oh, well, the market's going down. What's that going to mean for gold? Here's NUGT. It can be very, very difficult to try to trade commodities because you're not trading news today. You're trading, it's almost a derivative because this trades based on the value and the perception of other things in the market. All right, so let me put my slides back up here. Now, when we're talking about the VIX, there are times where I've traded it more in the years when we were having a lot of really volatile FOMC meeting minutes. But in recent years, I haven't traded the VIX very much. During extreme market conditions, like a 300-point sell-off, we could watch the volatility index for bounces. And you can, interestingly, trade inverses, where you have the VIX, and then you have the VIX inverse. And so this is interesting. When the VIX goes down, UVXY goes up. So this is VIX, and then UVXY is the same as VIX, and SVXY is the inverse of the VIX. So when UVXY goes down, SVXY goes up. These are direct inverse. So you can trade, you don't have to go long or short. You could trade both of them to the long side. Some people will do that type of thing because there are restrictions about shorting stocks with retirement funds. So people who want to trade with retirement funds need to instead buy an ETF or a mutual fund that is a collection of shorts, which is just an interesting thing in the market. But again, it's important to understand these exist, but from a realistic perspective on a day-to-day basis, it's not the type of thing that we're going to trade. Our focus is trading stocks with the potential to move 20, 30% in a day. That's not going to be the entire index. It's not going to be generally a commodity or anything like that. But you also probably know a lot of traders talk about penny stocks. All right, so one of the things that I was first getting into when I started trading, I was interested in penny stocks. I knew that a lot of traders with small accounts would trade penny stocks. You put $10,000 into a penny stock, you can maybe double your money overnight. That's the type of thing that you would hear about. So what are penny stocks? Well, penny stocks traditionally are stocks priced under $1 per share. But the SEC considers a penny stock to be any stock trading under $3 a share. So I traded, in that sense, penny stocks when I built up my account from $583 to $100,000. So I focus, as you know, primarily trading stocks between $1.50 and $10. So that means sometimes I'm trading stocks that would be technically classified as penny stocks. But when I personally talk about penny stocks, I'm talking about stocks under $1 per share, and I never trade them. I trade between $1.50 and $10 because those are the price ranges that are, number one, most likely to make those 20 to 30% moves, but number two, are most popular among retail investors. As they get to be a little more expensive, they become a little more popular than like 50 or 60 cent stocks. All right, so here's a stock that went from $2 to 350, giving us easy entries on the pullback. This is a trade that you could have easily made, $10 or $15,000 on it, and you would have been easily able to get in with 10, 20, 30,000 shares and get in and get out. You have the liquidity. This is a 100% intraday move. All right, here's a stock that went from $1 to $2. Again, a 100% intraday move. Now, one of the reasons I don't trade stocks under $1 is because they don't trade in 1 cent increments. All right, and I'm going to talk about that in a minute. But as soon as stocks cross over $1, they now trade in 1 cent increments. So $1 by $1.01, $1.01 by $1.02, but never tighter than that. And that means the stock can start moving much faster than when it's below $1. All right, here's a stock made $4,300 on this day, from $2 to $680 in 1 day. And again, I mean, $4,300 was not me even being aggressive. There's probably traders who made $20,000, $30,000 on this stock on that day. From $2 to $9. Okay, so you can see why these are the types of stocks that I'm going to focus on as a trader. As a day trader, this is what I'm looking for every single day. I'm looking for a stock like this. Now, I might not find it every single day, but if I find it on 3 days out of the week, right, that's going to work. I don't need to find it every day if I can find it a couple times a week. Okay, so penny stocks. Stocks that trade over $1 per share trade in 1 penny increments. Okay, so 380 by 381, 381 by 386. This has a little bit of a spread. But stocks that trade under $1 per share trade in increments of 1/100th of a penny. Okay, think about that. That means an 80-cent stock might look like 0.8199. Here you've got this stock that's trading at 26 by 26.27. So for it to even get up to 27 cents, look at how much it has to move through. It has to move through, I mean, it's crazy. It has to move through more than 100 spots. I mean, you've got all of these spots it's got to get through. 29, 39, 39, 40, 50. So you've got 100 spots that it has to get through before it's going to move to the next penny. And that's why stocks move so much faster when they're above $1 per share. All right, now the NYSE requires all companies to keep their stock priced above $1 per share. If a stock drops below $1 per share, they'll be given a delisting notice, and they'll have a certain amount of time to get the stock back up above $1 before they risk having their shares suspended from trading and getting delisted from the exchange. NYSE can say you're off the exchange. NASDAQ, NYSE, they can say you're out. You no longer meet the minimum listing requirements, and you're off the exchange. A company will want to keep its stock on the NYSE or NASDAQ if possible. You don't want to go backwards. You don't want to get delisted. So they're always going to try to keep their stock above $1 per share. And this is where reverse splits come into play. Okay, so a reverse split is a ridiculous thing where what a company will do, if the stock is trading at 10 cents per share, they can do a 10-to-1 reverse split. And that means that if you hold 10,000 shares right now at 10 cents, the next day you'll be holding 1,000 shares at $1. They've done a 10-to-1 reverse split. For example, if a stock is trading at 50 cents and you're holding 10,000 shares at 50 cents and they do the 10-to-1 reverse split, the next day you'll be holding 1,000 shares at $5 a share. So they've just done a conversion. They've reduced the number of shares in exchange for increasing the price. It's a trade, and you don't make or lose any money when they do a reverse split. But what does happen is the float changes. If you do a 10-to-1 reverse split and you have a 10 million share float, your float just dropped to 1 million shares. Okay, that's a big change. Now your float has gone down. And what we have found is that stocks right after reverse splits are now suddenly priced from what they were as a penny stock now into the $2 to $3, $6 price range, and now have a very low float. They can sometimes make a really big move. They can make a really big move. So this is the interesting thing. You can get a reverse split. The stock starts to put in a little bit of a move, and then maybe the company comes out with a headline, some good news. Maybe they paid off some debt, or, well, they obviously have the news that they're now compliant with NASDAQ, which by itself is good news. But if they have a little bit of a headline and the stock can now go up to $6, $7, $8, $9 a share, they can do a secondary offering. A secondary offering is a second IPO. Now they could go and sell 2 million shares onto the open market at $8 a share and raise more money. They raise more money, the float goes back up, the stock comes back down. The company has succeeded. They've raised money. The stock is now trading above the $1 minimum. But who really loses usually is the long-term investor who's holding, because this is what stocks look like when they do reverse splits. They just go lower and lower and lower and lower. And they can continue to do these reverse splits. They can continue to do reverse split and secondary offering, reverse split, secondary offering. And you see it happen all the time. Now, knowing this is a pattern, there are some opportunities inside this pattern. So there is potential to trade through reverse splits, not holding through them, but just after reverse splits and anticipating a possible secondary offering. Okay, now in recent years, and then you've got the OTC markets. Now, if a stock does get delisted from the national exchange, they can move on to the OTC exchange, which is the over-the-counter exchange. And this is where most penny stocks will trade. And this is where you have the pink sheet stocks. All right, these are the stocks that generally are, some of the, they have the least amount of regulation, especially when compared to NYSE and NASDAQ stocks. So it's where you're more likely to see stocks that are getting promoted. When you get, like, if you've ever gotten a postcard in the mail for, XYZ is going to go up 500% today. Those are usually for pink sheet and OTC stocks. Now, in recent years, the OTC market quoting system has made electronic quotes available for most OTC stocks, and liquidity has improved, but it's still not at the same level as national exchanges. So when you press your order to buy, sometimes it can take 10 or 15 minutes for your order to get filled, which is crazy. To me, I mean, it's crazy. And I never trade OTC stocks. I don't ever trade them. So that's just not something I would trade. Most of them are going to be priced under $1 anyways, but I wouldn't trade them. Now, within the OTC market, you have OTC tiers, all right? The first tier is the OTC QX. This is the best quality. This is the best, it's called the best market. It's the best of the OTC stocks, all right? So to qualify for the OTC QX, the companies do have to meet the highest OTC financial standards. And they've got to follow best corporate governance practices. They've got to demonstrate compliance with SEC laws, US security laws, etc. So these are considered the best of the OTC stocks. And then you have the OTC QB market, the venture market. These companies have to be at least 1 penny per share, and they cannot be in bankruptcy. All right. They're also required to submit annual reports to show some financial transparency. And then you've got the pink market. These are the stocks that don't meet the OTC QX and they don't meet the OTC QB standards. These are actually even subdivided into categories below the pink market, and we won't even go into all those categories. But for right now, know that the pink market is where you see essentially it's the bottom of the OTC tier, and it's where you see some pretty poor quality stocks. All right, now a traditional penny stock trades between 1 penny and 99 cents, right? That makes sense. They trade in increments of 1/100th of a penny, but they continue to trade above 1 penny. Now, we don't often see penny stocks on the NYSE. We will see traditional penny stocks between 1 penny and 99 cents on the NYSE and on NASDAQ. These companies may not have gotten delisted yet. They may be getting ready to do a reverse split or trying to get their price back up above $1. We don't usually see ones as low as 1 cent, but we often see them in the 50 cent, 60 cent, 70 cent range. But of course, generally speaking, these are stocks that are really in not good shape, and they are potentially facing delisting. All right, so you can see right here, this is a traditional penny stock. This is Gevo, 20 cents. Well, because it has, you'd have to look at it like here. RGSE, this is with the 100th of a penny, 2571 by 2579. And then you have FOT, which is 1 penny by 1 penny. And you've got T-log, which is 11 cents by 12 cents. Then you have sub-penny stocks. And these trade between a tenth of 1 penny and 9.0099. So this stock here, for instance, is in between that range. These are sub-penny stocks. They're just below a penny per share. And you can see these are like impossible to trade. You can barely even see them. Those are called sub-penny stocks. And then you've got the Trip Zero stocks. Trip Zero stocks are priced with 3 zeros. Trip Zero stocks are priced between 0.0001, which is literally the lowest price a stock can possibly be, and 0.0009 per share. Okay? These are the types of stocks that are often used for manipulation. Just imagine if you got $1 million worth of one of these stocks at 0.001 and 0.002, and then you put out all those postcards and you put out all those hot penny stock tips, and it goes up to 0.001, goes up to 1/10 of a penny, that's $10 million. And that's why you see a lot of those companies registered in like Panama or in South America or wherever they are promoting these companies. This is the very bottom of the barrel. I would never trade these stocks, but it's important for you to understand what they are. You will see emails from time to time of people promoting these types of stocks. They're promoting them, and when you're buying from one of those guys that's in from 0.001 and 0.002. Okay, so these are kind of the tiers of the market. You know, you've got, for me, I only trade above $1, but you've got below $1 down to 1 cent, and then you have from 1/10 of a cent up to 1 cent, and then you have the triple zero stocks, the Trip Zero stocks. All right, Trip Zero stocks look like this: 0.001 by 0.002, and again, the price action is like there's nothing. I mean, there's no price action. There's no charts, there's nothing you can trade here. So you just leave these ones alone, and these are just the type of things that maybe a newbie trader will get into, thinking that they're going to double their money overnight, and most likely they'll lose their money. All right, so you can reduce your risk as a trader by not trading OTC stocks. Some traders feel comfortable trading OTC. That's fine if they do, but I don't. And I would never encourage any of our students to trade OTC stocks. I feel that the risk does not outweigh the reward. So for me, there is just so much more upside potential to trading a stock listed on the NYSE or on NASDAQ. Stocks that are priced between $2 and $10 a share, those are stocks that I can put in $100,000 or $200,000, and I can get it back out 15 minutes later if I want to. And I would never feel comfortable doing that on an OTC stock. But I can do that on NYSE, NASDAQ stocks all day long, every day if I want to. So that's a much more scalable strategy. I can make $60,000 in a good month trading stocks between $2 and $10, and I can do that pretty consistently. You cannot do that on OTC stocks. You just can't. All right, so now as you get started, it is super important for you guys to track your trades. And in a few minutes, I'm going to show you the platform or the Excel doc that I use for tracking trades. I want you to track every single trade that you take. You guys, for the next, for the foreseeable future, are going to be trading in the simulator, and I want you to track your trades so we can start to get a benchmark and really a baseline of what your metrics are right now. Now I see John's in the room. He has his metrics. He knows what his metrics are. I know what my metrics are. He and I both have the metrics of profitable traders. A lot of you guys who are beginner traders right now, your metrics are probably, they're not super great. You're a beginner trader, and that's okay. But you don't want to trade with real money until you have good metrics. And you won't know your metrics if you're not tracking your trades. So you've got to start tracking your trades. Now, before we get into that, I want to show you how to set up your trading station. Now you can see this here. This is my 11 monitor trading station. I've got 8 20-inch monitors up top, and then I've got my 3 laptops. So 8 plus 3 is 11. So what do you need? Well, you really need to run Windows. Now, if you're running a Mac right now, that's okay. You can run Windows on your Mac, number one. But most traders, if you can afford it, are going to be better off just getting a Windows machine. Most trading software is on Windows, so it's just going to be easier for you than trying to run Boot Camp, in my opinion. But it's totally your call. I know Jeff for a long time has been using a Mac for his trading, and he's happy with it. I know Mike has a Mac, and it's fine if you want to, but I personally use PCs, and I'm happy with them. Number one, you need at least probably one laptop or one desktop computer. You need a couple of external monitors, $133 each. You need a couple Diamond USB to HDMI adapters. You need a triple mounted multi-monitor mount or slash rack, $89. And you need a USB adapter with 4 extra ports. Total equipment cost, if you buy all new, $1,400 to $2,100. That's your total overhead. I mean, this is a business last year where I made over $200,000, and the total overhead in terms of equipment is $2,000. That's a really, really good return on my investment in terms of the 1% to that return. Okay, so the laptop, I like Lenovo, and I've been using Lenovo's for a long time. These are used by a lot of hospitals because they're reliable. The most important thing with the PC that you get is that you get a solid state hard drive. These are faster, they run cooler, they don't get hot, and if you drop it, it usually is not going to get broken. It's usually going to be okay. 16 to 32 gigabytes of RAM. Now, generally, if you look for a computer that's a gaming computer, it's going to be more than enough for day trading because gamers like the RAM, they like the solid state hard drive, they like the graphics card. So a gaming computer is going to be totally fine. I don't like touchscreens. Number one, I don't want to use them, but number two, they can interfere with trading software. So if you have a touchscreen, you usually want to disable it when you're trading. But some softwares, for some reason, conflict with the touchscreen. So I specifically ordered mine with no touchscreen. 15-inch or 17-inch monitor, that's your choice. Setting up your trading station, part two, number two, 24-inch monitors. Asus, $133 each on Amazon. Those are super cheap, and they're great. I've got 8 of them. I love them. Number three, Diamond USB to HDMI adapters. They're $49 each on Amazon. I can power 8 monitors on my laptop using these. Now, I split my monitors between my 3 laptops, but if you only have one laptop and you want to run 4 monitors, you can do that using this USB adapter. What you do is you plug this in to your USB port, and right out of the back is an HDMI cable to power your adapter. Simple multi-monitor mount. You've got your 3 monitors with 1 laptop in the middle, $89 on Amazon. And then this is your USB adapter. So here is where I plug in monitor 1, monitor 2, monitor 3, monitor 4. And then all I have to do each day when I want to run my system is I just grab my, my little plug right here, plug it in, and I'm good to go. They all fire up. All right, that's it. I mean, it's that easy. It's pretty simple to get squared away. I don't use external mice. I just use my trackpad, which is fine for me. One note, though, if you use external keyboards or external mice, you never want to use a battery-powered one because when the battery power runs low, it'll start multi-firing. So you might press Shift 1 to buy 1,000 shares, and it locks. Now imagine if that happened with my account with $400,000 of buying power. I could be holding 110,000 shares of a stock and getting slippage the whole way up. That's dangerous. So you always want to use hardwired if you're going to use something external that's not connected to the computer. Also, a good idea is to use hardwired cables. I use for my computers, just these Ethernet cables, so I'm directly connected into the back of my router. It just avoids the risk of dropping dropping your Wi-Fi connection. Something I also recommend that you do is, on a sticky note, write down your broker's phone number and tape it to the top of your computer in case you're ever, in a trade and you lose power, something happens, you can give them a call, they can get you out of your position right away. All right, now tracking your trades, we're going to jump into this in 1 second. That's going to be part 2 of chapter 1 here, so we'll do that in 1 second. And then just a couple kind of, words of wisdom. We all have our place in the market, and I think I'm going to bring out a couple of analogies here. If I was going to throw you in the ocean right now, you need to be able to swim 1 stroke. You don't need to be so-so at the butterfly and so-so at the breaststroke and so-so at the crawl. You need to be good at 1 stroke. That will keep you alive. It's the same with trading. I don't want you to be so-so at this and so-so at that and so-so at the other thing. I want you to be a master of 1 strategy. I'm going to show you the strategy that I've mastered, which is momentum trading. That's looking for these opportunities to capitalize on the 20-30% moves. All right. Now, that'll be my focus. I'm going to teach you that strategy, and then after that, we'll teach you the reversal strategy. All right. So some traders will prefer that one, and that's okay too. But I want you to try to become a master of 1 of those 2 strategies. When you get to that level, you'll be able to essentially at least tread water, if not make small progress as a beginner trader. Now, as you get started, don't be surprised if your accuracy is low. A lot of students start with accuracy as low as 30%, and that's okay. So when you're trading in the simulator and you're tracking your trades, you'll see that, as a beginner trader, you've got a learning curve. But what you'll also likely notice is that you'll have a natural aptitude for 1 strategy or another. So that's why it's important to be really diligent about tracking your trades and identifying which strategy you were trading. That way you can go back and say, yes, this is the strategy I'm doing a really good job with. This is the one I need to focus on. I need to let the other ones go. All right, so this is, again, learning to tread water in the market. It's not about being a jack of all trades. It's being a master of 1. Master 1 setup, and even if you only trade that 1 setup twice a week, that setup is enough for you to make a living as a trader, right? I mean, it's really that simple. 1 strategy. If you have 1 strategy where you consistently take money out of the market, you're doing something 90% of traders can't do. And that's why I focus on teaching you the exact details of my strategy. Like there's a lot of little nuances, and I want you to understand it inside and out. Now, I know that some of you guys will think that, especially in the live trading examples, that I'm making this look easy. The reality is, for me, right now, it is easy. The hard part is strategy development. That's what you guys are working on right now. That's the hard part. But once you've got it, you've got it. Now, having said that, there are things that you can do to make life easier on yourself. So this is the next analogy. Think about trying to ride a road bike on the sand and the beach. No matter how hard you try, you're not going to make any progress because those skinny little tires are going to sink into the sand. And then here comes Ross on one of those beach bikes with the fat tires, and I'm riding on the sand without any trouble. I'm making it look easy, but it's because I'm using the right tools for the job. I've got a lot of students who come in and they say, well, I'm trying to trade your strategy, but I'm using my iPhone and it's just not working as well. And I say, well, you're using the wrong tool. That's like trying to ride a road bike on the beach. You're using the wrong tool for the job. Okay? Other students will start trading with real money before they have any, really any education and before they've gone through the training. So again, these are students who are just simply not in the right place to be trading. They're not ready. You need to focus, number 1, on learning the strategy. Number 2, practicing it in the simulator. And then number 3, building your experience with real money, but starting with small size. Okay, so just be mindful that you need the right tools for the job. I'm going to share with you all of the tools that I use for trading. But if you're trying to trade and you're trying to do this on your own using different tools, you're most likely going to struggle. All right, I've chosen the tools that I suggest for a good reason. Okay, that includes the broker with direct access routing, with hotkeys. Right? If you're trying to trade without hotkeys, you're trading at disadvantage. If you're trying to trade without level 2, you're trading at disadvantage. If you want to conscientiously choose to trade at disadvantage, you can do that, but you're kind of setting yourself up for failure, right? I mean, It's kind of true. I was recently went shopping with my wife. I was looking for plants for my office, and I was picking out all these plants that I liked. I thought they looked really good, and she said, "Ross, you're picking out plants that are really hard to keep alive." And I said, "I don't care." And she said, "You're setting yourself up for failure." And it's true. They're probably all going to die. I've got one dead one already. I set myself up for failure, right? I didn't have to do that. I could have picked a couple of ferns. I could have picked easy plants to grow, but instead, for whatever reason, I decided to pick some of the hardest plants. I don't want you guys to do that with trading. I want you to do everything you can to make this easy for yourselves. It doesn't have to be that hard, but if you try to, not follow the rules, it's going to be a lot more difficult. All right, so here's a question. Is trading like fishing? Maybe it is, maybe it's not. Well, many of you guys know that I'm a pretty big fan of the deadliest catch. And there are times where I've been able to draw some really good comparisons between my day-to-day life as a trader and what I see from the outside as being the day-to-day life of these guys fishing for crab. Here's a couple of examples. Number one, those guys who go out there, they have certain days where the weather is great and they can get a lot of work done. They can set a lot of strings of pots, they can pick up a lot of strings, and they can fill up their boat. Those are days when fishing is hot. I have days when trading is hot, and I can get out there and trade and make $4, 5, 6, 7, even $10,000, even $22,000 on my best day so far this year. Okay, so those are days when trading is hot, days when fishing is hot. But what's interesting is that when there's really big storms, they don't try to fish through the storm. They take shelter. Now, the risk for them is that they don't want to capsize the boat. They don't want to die. So many of us with our trading accounts trade through really bad trading conditions. We don't reduce our risk. We trade with just as much risk, and then we have drawdowns. We give back $5,000 in a single day, maybe $10,000. My worst day was a $30,000 loss, and it was 100% avoidable. It's important to learn when to seek shelter from the storm. Now, another comparison is the fact that those guys that are out there fishing, it seems that a lot of times they catch some of the most crab when they're fishing really close to the ice pack. So they fish close to the ice pack and they'll put out a line of fishing pots. They'll pick them up. They'll have, great, they're all full. And they say, you know what? I'm going to set them back. And they set them back. And then what happens overnight, the ice moves down and it covers the pots. And now they've got to go back and try to rescue their pots. And there's risk that they could lose every single pot that's in that string. And that could be $100,000 of equipment lost. Now they push their luck. That's kind of like me getting in a stock that squeezes up 10 points and then buying it 10 points high for that second breakout and then giving back everything I made on the first trade, taking too much risk. Right? And pushing my luck. Now, at the same time, you will have losses. And at the same time, you've got these boats that sometimes they have engine failure and they've got to go back into town. And that engine failure might cost them $50,000. For us as traders, we will lose money. We will have days where we lose money. And over the course of this year so far, I've made about $140,000 in profit and I've lost over $100,000 in losses. I have a total of $140,000 in profit. So I guess I have probably $60,000 in winners and $100,000+ in losers. Losses will happen. You don't need to beat yourself up about it. When these guys have equipment failure, I don't really see them beating themselves up about it. They're just like, this is part of the job. As traders, this is part of the job. Sometimes you push your luck, you lose some equipment. Sometimes, something happens, you could blame yourself, but the reality is this is part of being self-employed. You're going to have unexpected things happen. You will have losses. Even the best traders are only right, 70, maybe 80% of the time at most, which means they're still wrong 20% of the time. Learn to take those losses in stride. Bounce back from them. It's not that big of a deal. All right, so now steps you can take today, and these are steps you can take as you begin your journey. Number one, obviously start tracking all your trades in our Excel doc, which I'm going to show you in part 2, and start trading in the simulator. Number two, stop trading with real money until you've proven that you can be a consistent trader. This is important. I want you to prove to me that you have what it takes to be profitable. But you have to prove it not just to me, but to yourself. Prove it to your family. Prove it to your friends who are supporting you, who are there saying, I don't know if you have what it takes to be successful. This is crazy. Day trading is so risky. Why are you doing this? Show them with your paper trading statistics that you have a profitable strategy. All right. Now, if you have a current trading history, you can import that trade history to a website like TraderView to pull your stats. And you want to data mine that information. You want to know your metrics. Now, what are some important metrics that every trader needs to know? Number one is your accuracy. Number two, your average winners versus your average losers. Number three, what time of day do you typically make the most money? Number five, number three, number four, whatever. You want to know the price range where you typically make the most money. All right. Those are the stats that you need to know. You can get those stats from our simulator. You can get those stats from TraderView if you currently have trading records that you can import. And you can get those stats from our Excel doc as well. All right. Now, I'll also say this a lot during the course. Number four, don't be a follower. Just because you hear me saying I'm taking a trade does not mean you should buy it. You should not follow me. Here's the problem. If I say I took a trade, you're buying behind me. And I don't want you to buy behind me. If I'm saying I'm taking a trade, I'm almost always saying, guys, I'm watching this stock over 350 because the break of 350 is the first 5-minute candle to make a new high on this bull flag, right? I want you to buy at 350, not because I'm buying, but because you understand that's the right place to buy. So let's say, I'm trading from, Guatemala or something, and I have a 5-second or 10-second lag on my internet connection. By the time you hear me say I bought, the stock might already be at 370. So I want you to get in, not because I'm saying I'm getting in, but because you understand the setup. And this comes back to give a man or woman a fish, he eats for a day. Teach a man or woman to fish, he or she eats for a lifetime. And that's what I want to do. I want to teach you to fish. And I've had so many students, John, of course, is in these classes today, who email me and say, Ross, my life has changed because I've become a trader. I now know how to trade thanks to you. For me, I was thinking about this as I was getting ready for this class, the fact that there was a time, not that long ago, where I was sitting down at the end of each week, scratching my head wondering, when am I ever going to figure it out? And am I ever going to be consistent? When am I going to get past this emotional issue that I have of, holding my losers too long and selling my winners too soon? And here I am now, suddenly, years into trading consistently and feeling so confident. I don't know when that transition really happened. It just, at some point, there was a shift. Now, one of the things that I did to myself is I put myself in rehab, trader rehab, and I did it several times. I think the shift happened after my last stint in trader rehab. Trader rehab is something that I had to do to myself because I kept losing my control emotionally. What did that look like as a trader? That was me taking trades and losing money, losing $3,000, and then taking a second trade and losing another 2,000, taking a third trade, losing another 1,000, and having days where I just snowballed. I would call it a snowball day because I would throw logic to the wind and I would just trade impulsively and emotionally. So how many of you guys have felt that way before? How many of you guys have traded emotionally, have traded when you're angry, when you're frustrated, and you knew you were doing it, right? So many of you have done that. Now, I can tell you right now, with my intellectual mind and with your intellectual mind, you know that it's a bad habit. You know you shouldn't do it. You know you should stop doing it. But here's the problem. You have your intellectual mind, and then you have your emotional mind. And when you're allowing your emotional mind to take over, all logic and all reasoning and all the intelligent stuff that you understand is gone, and you're just focused on emotion. So what I want you guys to do is just think for a minute about the last time you saw a stock running up and you decided to just jump in it way too high. What was that feeling that you were having? You saw this stock running without you and you were missing it. Think about that feeling. You need to get to know that feeling. And you don't need to be avoiding that feeling. You don't need to be angry that you have that feeling. You need to be aware that that feeling exists And you need to have a circuit breaker in your own mind where you say, I'm starting to feel frustrated. One of the things that I started doing every time I took a trade is I would write down my emotional state when I took the trade. I'm feeling pretty good, feeling pretty good, feeling pretty good. I'm feeling really angry. I'm feeling really frustrated. And when I would have one trade where I was feeling frustrated, as soon as I wrote it down, it's almost like by writing it down, I snap out of the emotional side of my brain and switch to the intelligent, and I say, it's time to close my computer. I got to get away. I got to stop. I don't want this to be a day where I risk giving up, my future as a trader because I lose $30,000. That happened to me. I had a day where I lost $30,000 being an idiot, being emotionally impulsive. Emotionally impulsive, trading in anger, trading in revenge, trading out of frustration, that's all emotional trading. You will never be a profitable trader if you allow yourself to trade emotionally. Now, emotion is something that every trader has, even an experienced trader. I have it, John has it, lots of other traders have it. We're not trying to suppress emotion. We're not trying to be robots. We're not trying to achieve the impossible. We're trying to get to a point where we can see emotion and we can be angry, we can be frustrated, and we can make the decision not to act on that feeling. And if you can achieve that as a trader, you're going to become a better person in your day-to-day life because you're going to have the ability to calm down when you're feeling frustrated. When you're in an argument with someone, you're going to be able to bring yourself back down. Trading is something that's going to test a part of yourself that you probably never expected to be tested, especially in trading. I know it wasn't something that I expected to have to go through. And it was absolutely my biggest struggle. I bet for the majority of you, your biggest struggle will be the emotions of trading. You should be able to understand the techniques pretty well, but you'll get into a habit where you're not taking good entries, you're chasing, your losses become bigger than your winners are very small, and you're in a downward spiral. And then you get emotional, you get frustrated, and it continues. Now, we'll have classes specifically dedicated to this topic, but I want you guys to understand right now at the onset that you need to start becoming aware of your emotional state when you're trading, because that will directly impact your ability to be a successful trader. Okay, so that's something that's just incredibly important. And again, there's really for me nothing that feels better than getting an email from a student who's gotten it, who's gotten through the learning curve, who's gotten through that emotional learning hurdle, and is now on the other side trading profitably. And for traders that have been through it, they know exactly what I'm talking about. This is just one of the challenges with this job. And I can't, I'm not going to say I don't get frustrated. I recently had a 4-day losing streak where I lost $15,000. I was frustrated, but I didn't allow myself to act on that frustration. And that's the difference. Okay, so I really want you guys to start being mindful of that. And it's developing a sense of mindfulness, a sense of awareness of your current emotional state and how it's impacting your trading. Okay, so we will talk about that a lot more later in the class. A recommended reading is the book called Trade Mindfully by Gary Dayton. You can check that out on Amazon. That's a good book. I think any books on meditation would help you, just on mindfulness. I think those would be good as well. Okay, so we're going to end here part one and jump into part two, which is going to be tracking your trades in the simulator. After that, we'll go into the frequently asked questions to answer all questions that you guys had on today's chapters.